All right, we got two big things to discuss this morning. We've got the broader cautiousness that we are seeing in North American trading, and then we have the latest read on inflation in this country. And it's interesting, you've got messaging that seems to suggest central banks in Canada and the U.S. are for now on slightly different paths. Let's bring in Christine Tan. She's a portfolio manager with SLGI Asset Management. It's nice to see you.
Good morning. Good to see you.
We can talk about the U.S. markets in just a second, but the big story here in Canada this morning was an inflation print where prices are showing some signs of softening.
Just
I know. We got to, yes, exactly.
Exactly.
And there seemed to be a takeaway because we saw the Canadian dollar a little weaker that maybe the Bank of Canada is justified for now in staying with this, okay, we're going to wait, see how things play out,
right,
and stick with hold mode for now. What was your takeaway on the inflation numbers?
I think you characterized it perfectly. Okay. This morning's print probably gave Macklem a big sigh of relief because on January 25th, he came out, hiked 25 basis points, and it was pretty clear. He said, we're on pause for now. But then we had a really big jobs number.
That's a great point, yeah.
So he was probably on edge thinking, well, are we going to be forced to act? So today, it's just a titch softer than expectations, 5.9. But if you delve into the details, so our team really thinks it's important to look at the details at this point in the cycle. So things that are fading continue to fade. And the three components that are still adding a bit of pressure to the upside is shelter, and we know why that is, because mortgage costs have gone up.
Right.
And food, again, we know that's something we feel every day when we go shopping. And gasoline, but that's moderating a little bit as well compared to the worst levels of last year. So even looking into the details, there's reason to at least be a little bit optimistic, but again, data dependent. You have to continue to do what the Fed is, or what the Fed and the Bank of Canada is doing.
Well, to your point about housing, I mean, if your rent is up or if your mortgage costs are up, a lot of this ties back to the fact that interest rates have been rising at such a rapid clip. And Macklem himself has already talked about that reality, the level of debt Canadians hold, and the weakness we've seen in the housing market as arguments for actually being in pause mode now, because we just don't know what's going to happen on that front.
Exactly it. If you look at the rate sensitivity of the Canadian market, the fact that our mortgages are so much shorter, and we have a lot more adjustable rate mortgages too. Like this morning, they were saying in the U.S., 91% of mortgages are fixed.
Lock it in for 30 years.
Exactly.
Or whatever. Yeah.
So the rate sensitivity, which is what makes it a bit more challenging for the Fed, we don't have that here in Canada. So it really does speak to Macklem taking a prudent approach of waiting and seeing.
Now, going back to the U.S. story, and there's a few moving parts this morning. You had a couple of big retailers like Home Depot and Walmart with softness, and so that influences the trade. But there does seem to be this view that central bank can continue to raise interest rates. You mentioned the differences on the housing side, but you also talked about a strong jobs report here. I mean, we have continued to see pretty resilient, outside of Walmart and Home Depot's forecasts, resilient consumer activity in the U.S., which seems to make it complicated for the Fed.
Absolutely.
Yeah.
Even in Canada, our retail sales is, I wouldn't say quite as resilient, but it is holding in, right? Because as long as people are employed, as long as they feel like they can find a job if they want it, and unemployment rate is still at a multi-year low at around 5% in Canada. So it does speak to an economy that's maybe not as tight as it was, but it's certainly not a whole lot of spare capacity in it at the moment.
So I know a lot of people feel more cash-strapped these days. I know there is uncertainty out there. We don't know how these interest rate hikes are ultimately going to impact the economy in 6 or 8 months. But the conversation seems fairly balanced on, interest rates moving to more normalized levels, an economy that's hanging in there, some signs of inflation easing. So as a professional investor, what do you do against that backdrop?
It's tough because we know there's a slowdown coming, maybe not an outright recession, but the timing is the tricky part. And certainly both Canada and the U.S. is proving to be a bit more resilient. So what we're doing is on the equity side, we're very cautious, quite defensive. We like dividend payers where we can own it. And then even companies, you can own discretionary, you can own industrials, just make sure they're companies that have a more defensive quality to the business. And then we like bonds.
And bonds.
And with yields where they are, you're finally being paid to own bonds. And eventually, if we do believe inflation will normalize So yields will eventually come down as well.
Does that so? Do the bonds become a permanent part of the portfolio, or is it that idea of, well, you can get paid to wait here right now, so why risk it in the equity market?
It's a great question.
Yeah.
So I guess it depends on the investor, but for us, in our managed solutions, we always have an allocation to bonds. We believe it's just an important part of the portfolio.
Okay. And then you talked about finding those kinds of stocks or companies that are public that can navigate well, maybe have defensive characteristics. Are you looking for, companies that can say, yes, consumers are more challenged in their spending, or businesses are more challenged in their spending. However, our pricing power is fine. We're okay. I mean, what are the kind of characteristics you're looking for there?
So pricing power has been something that every single company has had for the last 18 months. We think that's going to fade.
Okay.
So we think there's going to be margin pressure regardless. But what you want to think about is, if consumers become more price sensitive, where's the trade down? What are the staples that they need to own? And these are the companies that they might see a bit of margin compression as well, but it'll be more resilient.
And then you talked about dividends. Is that just across the board you're looking at companies that have those good characteristics? Are there any particular sectors where you lean a little bit more heavily on that front?
Our Canadian managers like the financials. You have to be selective which ones.
Yeah.
Obviously, there's different. Our banks are very different in terms of their business mix.
Yeah.
But that would be an example.
And we'll be watching them to see they've got bank
very
earnings
soon.
coming, right? So never a dull moment. Christine, thanks very much. Good to see you.
Thank you, John.
Christine.